Single invoice finance is a tool you can use to increase your profits, improve productivity and save time. Here's a very simple example of how that can happen. Let's say your business builds state-of-the-art rickshaws. They cost you $15,000 and take 10 days to build. Your customers buy the finished vehicle for $20,000 and pay in 30 days. So it takes 40 days for you to get your working capital back and make you a profit of $5,000. Then you do it again. So what if just after you've completed and sold a rickshaw, one of the biggest rickshaw companies in the world comes knocking? Its managers have heard good things about you and want you to build a new vehicle for their fleet. This could be the big break you've been waiting for. But you have a problem. They want the rickshaw ASAP. You won't have the funds to build it for 30 days. Your first thought is probably to borrow the money from the bank. But what if it doesn't share your faith in the rickshaw industry and says no? What if all your credit options are maxed out? An alternative many businesses consider is to sell an outstanding invoice to an invoice finance company. It's a straightforward transaction, does not require you to take a loan, and you can have the cash at your fingertips almost immediately. Now, you know you'll pay a fee for this service, and the obvious question is, how will it impact on your profits? Here's a way of determining that based on monthly revenues. The first column represents what happens without invoice finance. Your cost of goods sold is 50% of your sales. Your variable costs are 15% at $3,000 and your fixed costs are 10%. Without invoice finance, your return on investment is 25% at $5,000. Now, what if you decide to sell that outstanding invoice? It gives you the funds to build and sell 2 rickshaws. The dollar amount of your variable costs increases, but percentage-wise remains at 15%. Your fixed costs remain the same. The cost of invoice finance would be in the region of $1,000. Your net profit is $11,000. You've more than doubled your income for the month and your ROI has increased. Let's say you want to ramp it up and build 3 rickshaws. In this scenario, your cost of goods sold is still 50% but might be lower because you're buying in greater quantity and have the ability to pay your suppliers in cash. Your variable costs are still 15% and we've increased your fixed costs by 30%. Because the invoice you sell is of a higher value than before, your fee will be higher, but your profit of $15,400 more than compensates for that. Invoice finance has enabled you to triple your profits in a couple of months. Let's put it another way. The opportunity lost by not using invoice finance is more than $10,000. But having taken that opportunity, you're now in a position to continue growing your business by using your cash surplus. The question to consider is whether this facility offers value for money. Do the benefits outweigh the costs, not just in money, but in time and effort? Learn more about how single invoice finance works, what other options are available, and their benefits to your business by watching our other videos. For an informal discussion, please call me on the numbers provided.